All right, Suresh Tantia, Senior Investment Strategist at Credit Suisse. He's joining us right now to take some questions and get us ready from a global perspective. How are things looking? Suresh, good to have you with us here. Thank you very much. You know, the world's going one way and India is going another. I'm talking about markets. Will there be, mean reversion at some point? Do you think this is likely to continue? When, if you have a specific comment on what we saw here in India on Tuesday, the last session, yesterday was a holiday market, local market holiday, and a huge move up led by very strong inflows.
Yeah, I think at some point of time we are going to see convergence. But right now, the issue is that the global growth is slowing down. When the global economy is struggling to grow even by 1 or 2%, Indian economy last quarter grew by 13% plus. And this financial year, it's expected to grow by 7%. So everybody is looking for growth. And I think India is one place which is offering growth right now. And that's why we are seeing this divergence playing out in the equity market. But eventually, I think it will converge as the higher interest rate in India also weigh on the valuation of the equity market. You highlighted earlier that Indian equity market is now trading at 100% premium to some of the other markets. So valuations are definitely expensive compared to the rest of the world.
Suresh, hi, good morning. But let's, for a moment, just talk about the mother market. In the US, do you get a sense that we have sort of resumed that bear market and would break the yearly lows?
Definitely, I think we'll see more downside. And what we have done from our side is we have turned underweight on equities day before yesterday. So basically, we see more downside playing out in the global equity market, specifically the US market. I think what we saw in the month of July and the first half of August was the typical bear rally, and that rally is over. The growth is slowing down, and we are seeing cost of capital has gone up. So at this point of time, US bonds look more attractive compared to the equity market, and we are going to see more outflows from US equities. So I won't be surprised to see if we see 5 to 10% kind of correction in the next few months and quarters.
Okay. I think the big question from an Indian market standpoint, Suresh, is that will this outperformance continue compared to global peers? Something that even Prashant was discussing earlier. In that context, if it does, where are the pockets of growth, you think? Because there's been a big move that we've seen in, say, consumption stocks, in banking names, in autos. This whole theme is playing out very well. Your views here?
I would still suggest to focus on the domestic economy. Those would be, once again, banks and FMCG stocks. Although banks have done extremely well, but they are not expensive compared to the rest of the market. And the credit growth is still very strong, around 15%. So I think banks would be the place to play on the domestic recovery. The other parts of the market, I think they could remain under pressure, something like tech stocks, because global economy is going to slow down, and that would mean MNCs could curtail their IT spending. So I won't be so bullish on the Indian tech names.
Would not be so bullish on Indian tech names. Suresh, how likely is it that, as you said, it's very likely we see meaningful downsides in the US, right? More downside from here. Does that necessarily drag the rest of the world lower? But the problem, to be fair, is not just the US, right? Very large, chunky blocks are slowing down. There's, of course, the US. Europe has been in a mess of its own for a while. And there is China also, which is meaningfully slowing down. The property market dragging things down significantly. So, I mean, you can make the argument that, investors at the end of the day want growth, and this is still a market which is seeing relatively much stronger growth. But you also have to pay top dollar for it, is it?
Yes, absolutely. So this story has played out so far. India has been extremely well compared to the rest of the world because of the superior growth story. But at some point of time, I think valuation will cap the upside. Indian equity market is still up year to date when the rest of the world is down 15 to 20%. I think as the global equity markets go down further from current levels, you will see some more downside in the Indian equity market. And similar to US, I won't be surprised to see the interest rate story playing out in India. As rates go higher, growth might eventually slow down and equity might look more expensive compared to the bond market. So I won't be surprised to see some downside in the Indian equities.
Suresh, we started to see quite a bit of inflow into Indian market after very aggressive outflows from the foreign investors. But the worry perhaps is this sort of hot money chasing sort of momentum, or is this some genuine shift happening from, say, a market like China and a couple of other commodity markets into India? What would be your view?
I think it's most likely the fast money or hot money, which was basically looking for technical opportunity. As the commodity prices came down, especially oil, I think investors were looking for oil importers, and India and Indonesia stand out within Asia on that front. But eventually, as the global markets go down, I would be really surprised if that hot money stays in India. I don't think you're going to see any substantial amount of foreign inflows when the global growth is going to slow down. Most likely, investors will stay back home, which would be the US market, or if the Japanese investors stay in Japan, not looking out into the emerging markets.
But so far, these have just been fears, right? For many months now, I mean, everyone's talking about a recessionary fear, but nothing has played out. I mean, the labor market is still very strong. Most of the, the personal consumption spending data in the US has been very robust as well. So if it doesn't play out in its entirety, do you think then India will receive a major share of the money that comes through?
I think the growth is going to slow down, because if it doesn't slow down, that would mean Fed will just continue to hike policy rate. Right now, the expectation is that the terminal rate would be somewhere around 4%. And even after achieving 4%, growth does not slow down, inflation does not come down, then Fed will have to hike policy rate more aggressively. And that would mean dollar would be stronger and INR could be weaker. And that could lead to outflows from the Indian equity market. So irrespective of the recession or not, I think the focus is more on the inflation picture. If inflation doesn't come down, then Fed will have to hike rates more aggressively, and that would mean there will be more outflows from India.
All right, we'll leave it at that. Thanks a lot for joining in and giving us an update on the global markets and how you're approaching it. Well, let's slip into a quick break on that note. On the other side, our list of top 10 stocks is lined up. Stay tuned.